But Mayuresh, in continuation with the entire manufacturing theme, where else are you placing your bets? Any newer avenues you think which have opened up of late?
So yes, Aisha, I think the entire mid infra stroke capital goods space still looks very, very interesting because earnings have still held up. I mean, if you look at the sequential numbers that these companies have been reporting have been exceptional. A, order wins have been extremely strong. B, the new orders that have come through are with better margins. C, the execution timelines have improved vastly, which means that a huge amount of operating leverage gets played onto their balance sheets, and that ultimately gets reflected in their ROCs and ROICs as well. Now, with such strong expectations in terms of a good order book and strong revenue visibility and operating leverage playing out, I think the earnings growth that we look at O'Neill of 20 to 25% can easily be achievable for most companies within the space as well. So I think within the large stroke, larger mid caps, ABB India is something that we continue holding on our global focus lists. Strong numbers, expect outperformance in terms of earnings delivery to continue. But a couple of stocks within the mid-cap universe. One, ITD cementation with management has been very, very bullish. They expect 7,000 crores in terms of revenues from 5,000 crores, a jump of almost 35, 40 odd percent. Margins should jump from 9.5 to almost 10.5, 11 odd percent, expecting 8,000 crores in terms of orders on the existing 20,000 orders that they're probably sitting on. The risk factor in terms of their exposure to the Adani Group, I think timely servicing is absolutely happening, both in terms of quarterly as well as annualized payments as well. So this is one stock which is very, very interesting from this space. And the other one is AIA Engineering. Obviously, the volume growth has been reasonable in the quarter gone by. Margins are tad bit on the higher side. They should normalize going forward. But even with 25, 26% odd margins, capacity is expected to go to around 5,20,000 tons per annum. Expectations in terms of a very strong order book at around 800 crores, more orders expected to come their way, and absolute expectations in terms of earnings to again exceed 20-25 odd percent with very minimal leverage onto their balance sheets, leading to better ROEs. So a very interesting space, Aisha. I think ITD and AIA is something that we continue liking.
ABB, ITD cementation and AIA engineering, these are the stocks that you're recommending at this point of time. But Mayuresh, what about the entire real estate pack? And would you rather play directly through real estate names, or would you probably look at cement or building material counters?
So I think the right strategy, Atisha, is that a few of these players have done exceptionally well, and numbers have been extremely strong. I mean, if you go and read through management commentaries right into Q4 and where we are now resting in terms of the peak of the rate cycles. DLF obviously has been a huge outperformer as far as the entire space has been concerned. A few of these South-based players, including the likes of Soba and Prestige, have delivered a good set of annualized numbers as well. And again, I think the kind of demand that comes through specifically from IT professionals for these South-based companies still looks extremely robust and strong. So I think a few of these companies can definitely be kept on the radar. But you're absolutely right. I think the real estate ancillary space is something that can also be looked at. What we are probably expected to see in terms of good growth expected to come through is something that can be played out. Obviously, a couple of stocks that we continue holding on the global focus lists are stocks like a KEI, Polycab. I think wires as a space expected to continue doing well in our opinion. Input cost deflation will play out very, very positively in terms of margins as well. And therefore, I think these stocks can definitely be kept on the radar. And let's not forget painting companies. I think in the second half, I think with the demand expected to come back very, very strongly, specifically repainting demand, I think that can have a huge impetus in terms of volumes. Crude prices coming off, crude derivatives coming off as well, will mean margins should remain extremely stable for these companies. And these companies throw humongous amount of cash. I think the free cash flows are extremely strong as well. So yeah, I think a few cement players, including the likes of Ultratech, should continue doing well. A few of these cable stroke paint companies can also continue to do well.
Mayuresh, what is the best way to approach the telecom story?
So I think it's a wait and watch, Aisha, very frankly, at this point of time. I think a couple of reasons. One, I think the data is highly consolidated at this point of time. I think most of the telecom players have weeded their low pricing plans and have migrated a lot of their users to the higher plans itself. The key trigger for these stocks are obviously going to be price hikes now, because I think they need to mitigate two aspects with price hikes. One, I think the kind of capex that they've got around 5G, both the bidding that they've probably done and the ecosystem needed to build 5G as a pan-India presence as well, and two existing spectrum auctions that still need to get serviced. So to a large extent, I think the trigger point in terms of ARPU increases, which should be consistent over the next few months, is something that can be a driving force for most companies within this space itself. Obviously, I think to the likes of a Jio and an Airtel, I think the subscriber base has been pretty large. They are obviously migrating a lot more customers from Vodafone Idea at this juncture. But I think the sole resting point remains ARPU increases, based on which I think the overall growth in terms of numbers can get reflected. Unless ARPU increases happen, my own sense is that it will not get reflected substantially in terms of bottom line growth. So I think a wait and watch for the sector as well.
Okay, wait and watch for that sector. But is it a wait and watch for the power sector as well, Mayuresh? Because things are looking incrementally better. But of course, we have seen multiple false start for this sector. Would you look at it seriously now?
So we did hold a few companies in our portfolios. I think we have done some element in terms of reaching our targets and therefore recommending investors to probably get out. A clear compliance disclosure will be stocks like PFC and PowerNet. So to a large extent, I think the entire story is now getting largely crowded at this juncture. Numbers are expected to be better in terms of peak power demand that we probably hit. And therefore, power consumption as a space should continue doing well, even in the next few months. Having said that, the base these companies are working on is also a very heavy base, and therefore the outperformance that we look at it from this juncture onwards is going to be a tall task for these companies. So I think only the outliers in terms of exceeding market expectations and earning expectations can continue doing well. But to a large extent, I think valuations and both price action are largely getting priced in for a whole host of stocks within the space.